All right, well, thanks everyone for being here, sitting through one of, I'm sure, 1,000 panels of the week. We have some great participants here today, so maybe we can start with just a brief intro on yourself, and then a little bit about your project, not too much chilling, but just enough to give the audience some context for our discussion.
Sure, yeah. Hi, everyone. My name is Mike. I'm one of the founders and CEO of Ether.fi. Ether.fi's ultimate goal is to make DeFi accessible and easy for normal people. Today, that consists of a suite of 3 products, Ether.fi Stake, Ether.fi Liquid, and Ether.fi Cash, that help users save, invest, and spend their crypto in real life. With Ether.fi Cash being our latest product, which is a wallet and credit card that lets you directly spend your crypto in the real world.
I'm Nick. I'm the CEO and co-founder of Agora. We've launched a new institutional-grade digital dollar, and what we're doing is creating an open model. So traditionally, you have exchange-backed stables like USDC. We're focused on having multiple partners, right? So in SynFutures' case, we'd work with them to share revenue of AUSD that's held as collateral on their platform, and they can use that cash flow to better their product experience, right? Whether that's lower funding rates, passing it through to the users, increasing their security budget. So we work with a variety of different partners. Those are exchanges, fintechs, dApps, et cetera. And so institutional grade, credibly neutral, that's us.
Yeah, I'm Tian, CEO, co-founder of Pendle. So Pendle is a protocol for the tokenization and the trading of yield. Among the use cases that the protocol enables, firstly is to enable a group of users to obtain fixed yield on some of the more prominent assets like Bitcoin and Ether. And the other one is, the other prominent use case is for yield speculation. So generally, if a user has a bullish view on a specific project, they can be the other side of the equation.
Hi, my name is Fred Xu. I'm CEO and co-founder of a company called D3. What we do is we unlock the entire domain name industry asset class. It's about a $300 billion asset class. Use cases. I have a couple questions for the room really quick. Who uses X? All right, second quick question. Who uses Google? All right, apologies for the dumb questions, but one of our investors sold X.com to Elon Musk for a very large amount. Another co-founder of ours personally sold abc.xyz to Google. So this gives for a very, very large undisclosed amount. So just imagine a world where you're able to not only buy, trade, but also borrow and lend against your domain name, like your real domain name .com, .net. So we bring composability, we bring liquidity to this asset class. Thank you.
Cool. So thinking about this topic, I think about my journey into DeFi. I've been in DeFi full-time for about 3 years now, crypto a bit longer. And I think a lot about the differences between Web 2 and Web 3. In Web 2, as a retail participant, there's very limited things I can do for speculation, right? I can go on Robinhood or any of my brokerage apps. I can buy a stock, or maybe if you're a little more savvy, you can play in the option space, right? But in DeFi, what's really interesting to me is I start thinking about why do people come to DeFi? Rachel mentioned arbitrage opportunities, airdrops. But I think something that's overlooked is just the robust ecosystem of investment vehicles that I can access as a mainstream user, right? One example is being able to LP into Uniswap, into SynFutures, taking the taker position, which is not possible in retail, because in Web 2. In Web 2, that's really only for institutional players. So I think in Web 3 it's very interesting because you have these complex financial products that are open to the masses. So as the first question, would love to get your thoughts on this consumerization of maybe historically institutional products and how you guys see the space evolving.
One of the things that I think is important to, for me, at least, to keep in mind, is that the reason that doing interesting things, doing things on Robinhood or other brokerages or other apps is valuable is because underlying those are productive assets that people are trading. At some point, somebody's turning something of lesser value into something of more value, right? There's actual economic activity. There's not a ton of that in crypto. Like, it's just people gambling. It's like this giant circular kind of solipsistic thing. And that's a problem. So I think the first thing, we have, like 17 different layers of infrastructure already for, anything that you want to do in DeFi. The first thing that I think actually needs to happen is to, start plugging crypto and DeFi into the real world so that these super complicated, really interesting, financial derivatives have some sort of base in reality. Because if we don't get that, I mean, this whole thing, gambling is a big market, but there's probably some cap that we'll hit.
Yeah, I think to Mike's point, right? When perp dexes first got going, it was to really speculate on crypto assets. But I think there's an increasing focus on bringing in traditional assets through different price feed providers, whether that's gold or oil or equities, so that you can sort of cross margin it all in one account. And I think that brings in a whole other segment of user. For us as an institutional grade stablecoin, many people just want to hold dollars and get access to a financial system, right? Whether you're in Argentina and you want to basically get out of your FX risk, or you're a woman in Afghanistan who cannot get a bank account. In many ways, crypto is promoting, financial freedom and access. And I think as we continue to build more real and serious products, that'll help consumerize the space. And even like basic infrastructure, like holding a stable in a wallet, is very valuable to people around the world, right? It's not just about speculation. And if you look at places like Mexico, 50% of that population is not banked, right? Because they're not good enough consumers for those banks. So I actually think what we can do with this space as we focus on more traditional and real assets and problems is bring in those people, right, who are also underserved, that aren't just here to speculate, but are here to access opportunities that they wouldn't be able to otherwise, and then help them grow their wealth. So
Yeah, I think part of that is also on education. I think, like, for example, like whatever I know about finance, I learned it through DeFi. The openness and the available opportunities within the segment is immense. And yeah, I just like that when it comes to DeFi, access is a lot more democratized. So you can come from any kind of background as long as you have the desire to learn. Like you'll probably be able to find a positioning. But I think getting that exposure is the first step. And I think over time, when more individuals get exposure to crypto products, the knowledge that they can gain through all these interactions will naturally compound. And I think that will generally permeate across like a bigger part of the a certain segment of the society.
Yeah, I think from my view, just like the subject of this panel, unlocking complex finance for the normal person, right, your average Web3 user. What are the things that they can easily identify with? Obviously walleting, obviously security, even things like real estate, right? And it's really kind of our job to make sure that these real assets, real utility come onto life. Otherwise, really, I mean, just my view, it is just sort of like a global circle jerk, right? Of a bunch of empty utility and just people trading off of empty assets.
Brett, maybe we can dive a little deeper into RWAs. You mentioned X.com getting sold for an undisclosed amount. Most retail people would not have an opportunity to get in to speculate on that, right? But you guys are tokenizing domains, and I like the idea of that because it's not just DeFi for all, it's DeFi for everything, right? The tokenization means you can financialize pretty much any product, domains being one of them. So would love to hear kind of how you guys are approaching that problem. And then the broader, like, where do you see broader growth in tokenizing some traditional real world assets like domains, but other areas as well?
Where we come from at D3, it's all about, like I said, it's about education and it's about what we call authoritative tokenization. anybody can tokenize anything, right? But in the case of gold, there's only going to be one entity, maybe some ETFs or maybe the US government, who will actually be the authoritative tokenizer, not the tokenizee, of that asset class. Once you do that, you bring in trust, right? You cannot have a true, easily liquid asset without that element of trust. So we believe in things like what we call, we're kind of pseudo-inventing, called authoritative tokenization. And it doesn't really matter whether, to us, it's domain names, which naturally have utility, and everybody kind of uses, they just don't think about it, right? Like, for example, every blockchain RPC endpoint is tied to some address. It's not just all IP addresses, right? You have to basically think about what that end user needs to see, right, before it becomes sort of given for the masses, as we talked about.
Great. And maybe a question for Tien and Mike. There are a lot of options for Web3 users to look for yield. There are a lot of different vault products out there, yield-bearing products. How do you guys approach sustainable yield? How do you define sustainable yield? And then how do you kind of distribute that to the masses?
I think sustainable yield is just like revenue that is not just a one-off event. So it's pretty similar to how you would evaluate non-Web3 business. There's got to be a steady income, regardless of magnitude, and I think ideally like some form of product market fit there, right? So I guess like when it comes to crypto, because the pace of innovation is quite fast, and a lot of times it's also extremely thematic. So some products can exist for a period of time, make a healthy amount of cash flow, and then when the trend switches from one to the other, and then it no longer becomes very relevant. But I think gradually, after several cycles, we're seeing products that are more lasting. Like for example, Aave is extremely resilient. The product functions, and then it's also generating pretty healthy cash flow. The other one would be Uniswap. The product market fit is there, and they probably just turned on the fee switch recently and then starting to generate some form of revenue. But even before that, the usability of the product is already very, very prominent, right? That's kind of how I think about sustainability when it comes to yield. Like there's got to be a good case of product market fit, and then whether it's meme coins or like meme coin season or RWA season, like these products have to be relevant. And in terms of like the distribution of the yield, there are quite a number of ways to think about it, but I think without crossing the boundaries of just crossing the regulators, some form of work is needed to be committed in order to claim some form of rewards there. Yeah.
I mean, there's so much that could be said about this. I guess where I come from, my background, what I kind of the lens I bring to Web3 is I spent over 10 years building a Web2 business, B2B SaaS. So I'm very much hardwired to not just think about businesses as far as actual cash flows, profits, and sustainability, but also understanding kind of how to build products that users want, and so these are things that are largely absent in a lot of crypto, because the basic business model of crypto is print a bunch of casino chips and collect a rake. So the danger of any kind of bootstrapping phase, which is kind of a weird unique crypto thing, where you're providing liquidity, you're providing incentives, is it really messes up your product market fit. It basically screws up the information that you need to get from users to decide whether what you're building actually makes sense. So for us, and I think this probably applies to a lot of crypto projects, it's this kind of dance of understanding sort of what phase of adoption you're in. In the earliest stages, you're just trying to get attention and the first few users. and then you want to understand like what you're ultimately building towards. In other words, you have to be building towards something that has some sort of cash flow positive, sustainable model, and knowing how to switch from one stage to the next to get to that end state. So for us, we've been slowly kind of ramping down the incentives to where now we basically shut them off. And I think we've done a pretty good job of creating a strong brand and value proposition as far as DeFi integration and this suite of products that hopefully we've created something of lasting value. But it's very much a bit of a minefield in crypto, and it's very easy, especially for folks that don't have experience maybe in more traditional business models, to fall into one of these sort of death spiral traps where it looks like you're succeeding, but really you're actually sort of circling the drain. I mean, there's a lot that could be said about that, but those are some basic thoughts, I guess.
That's interesting. Would love to follow up on that. How do you get out of that incentive spiral, right? Like, because once you start giving out incentives, I think you set an expectation with your community and your users that they'll continue indefinitely, which obviously is not sustainable. You guys have done a great job at scaling some of that back. What is some advice you would give projects about, scaling down that incentive system while still keeping the user base active?
Yeah, so I guess just to go back to what I was saying is you have to have the end state in mind. If you're building a product that's some deep in thing, for example, to pick a random example, you have to be very clear on what the end state looks like. Something that is a viable business that produces cash flows and creates enough value for your users that they're going to use it just because of that value that you provide for them. And at every stage, you need to be getting closer to that as you sort of ramp down the incentives. Whereas if let's see, and this probably applies to most crypto projects, if your vision is kind of like we're going to launch a token and cash out, and you're only planning for the next 6 months, the default is that you're going to get into that inescapable death spiral, and that's why every DeFi chart looks. Almost every DeFi chart kind of looks the same. Big spike, crash, and then rinse and repeat.
Great. So Nick, we had a chance to talk about stablecoins for a bit. Stablecoins are, in my opinion, the foundation of DeFi, right? And we're talking about complex products, but stablecoins to the end user are perhaps the simplest product out there. It's the simplest to understand. But I understand there are a lot of nuances in the different types of stablecoins, decentralized versus centralized, and even within that, there are different ways to approach stablecoin backing and issuance, right? Would love to hear your perspective on what creates a sustainable stablecoin that can power like the future of DeFi.
Yeah, I think there's a broad swath of different types of stablecoin products today. I think a lot of people try to lump them in together, but they're ultimately serving different users. I think it's very clear that the largest market for stablecoins is the equivalent of digital cash, right? It's Tether, USDC, us, institutional grade, stable assets that are backed primarily by treasuries and overnight reverse repo. Then you have this other tail of products which are catering to, I would say, more specific user personas, right? Athena's done a great job of sort of focusing on yield-bearing collateral and targeting big trading firms or large capital providers that want to earn additional yield as they're trading and on their collateral. But for us, we're focused on sort of the broader market, and who we're primarily competing with today are those large centralized players and really the duopoly cartel that doesn't let anyone else participate in their network, right? And so from my perspective and the seat that I was in, looking at Tether and USDC start to dominate, it seemed to me that those assets wouldn't have any value without businesses and those partners, right? If you don't have people listing your asset or encouraging their users to use it, those assets in and of itself have no value. And so what our focus is on basically building out the network in a credibly neutral, equitable way that is regulatory compliant. And so what that means is going directly to businesses, whether it's SynFutures or exchanges, and saying, hey, actually, it's you that is driving most of the value to this asset. And so sharing 60, 70, 80% of the income on those assets that are sitting on those platforms with those businesses. And then the beautiful thing is it's just cash flow. And so you give it up to the business owner to figure out what's the best way that I can bring benefits to my user based on my type of business, right? So if it's a B2B payment company, could just, hey, say reduce on and off ramps for their business customers. If it's a perp dex, it could be reducing funding rates or passing it through directly to the users that are using AUSD as collateral as opposed to USDC. And so for us, we're focused on that bigger market and are really flexible in the business model. I think as this space grows, like we're still very small today. Stablecoins are a $180 billion asset class. I think we hit 5 trillion over the next 5 to 8 years, and you're going to start to see maybe more niche players that base themselves to the dollar, similar to how Ethena tokenized and dollarized the carry trade. And with regards to those products, I sort of think about it as the fixed income market, right? If you want to hold treasuries, like those are the institutional grade stables, sort of like us, right? But you want to go further on the risk curve, it's probably a smaller market, but it's a juicier market for the people that are taking that bite of the apple, and so a little bit more profitable, and there are obviously different risks associated with that. So there's a lot of different models on that end of the spectrum coming into the market that I think are compelling, but that's how we think about it.
So on the riskier side, we have like decentralized algorithmic stablecoins, right? What are your personal thoughts on it, and how do you see the market share versus centralized stablecoins versus decentralized shifting over the next 5 years?
Yeah, I think algorithmic stablecoins that aren't backed at all are not good products, and I think we've all seen that for many obvious reasons. You will have a time of market volatility, and then those things will depeg and unravel pretty quickly. So I think you have to be backed by something, whether that's derivative products or it's a structured product, sort of like Ethena. Like that's okay as long as the team is competent, which that team really is, and they've done a great job. In terms of centralized, decentralized, if you're a decentralized stable, there's a lot more things that you can do, right? If you're a centralized product, you can't be really natively yield bearing because it's a security in 70% of global capital markets, right? And so you've seen like the centralized yield-bearing stables that have come out, whether it's from Paxos or someone else say, hey, if you're in the US, Canada, UK, EU, Hong Kong, Singapore, Japan, you can't touch this. Well, that means your ceiling of utility is really low because then not only are you deprived of centralized venues, but you're deprived of vendors like Wintermute or other market makers that may participate in your token. So I think the decentralized market will continue to grow from where it is today and actually be where more of the innovation happens and where you'll have like successful yield-bearing products. I don't think that's going to take place on the centralized side. I think the centralized side, there's not that much innovation needed, to be honest. It's more focusing on who are your banking partners, right? So we use State Street. They're one of the 3 largest banks in the world, so your assets are safe. And then also on the economic business model, BD team, there's some things that we can do on the tech side, but I think like the real like innovation in terms of like structured products, that'll like remain within the decentralized stablecoin landscape, and I think that's probably like 20-30% of the market over the longer term.
Right. So when we talk about bringing these complex financial products to the masses, the one thing we can't avoid is regulation, right? So it's an open question for anyone here, but what do you think the role of the regulator should be in governing some of the new products that we see in market? Even being like, should there be some regulation around being an LP into different either vaults or pools?
I think regulators that are just like leaning in and having an open mind are the most valuable ones. There's a reason we're all sitting in Singapore right now. I think they've been particularly progressive on newer models, right, in this space. The same is true about Hong Kong. The HKMA is taking at least stable coins and that process very seriously and being very thoughtful. ADGM as well has been really thoughtful. In other places and maybe more developed financial markets in the West, where there's a lot of incumbents who may want to, lobby to say, "Hey, slow down the innovators." I think those markets have been slower, right? But ultimately, I think regulators play a very important role in making sure that products are safe for users, and there's participants that are abiding by basic rules like not stealing your customers' money. That's a important one, which obviously has happened a few times in crypto, and so I think they play an important role And we're starting to see more people in Asia really lean in on the regulatory side, and I think having that cooperative relationship is definitely a good thing for users.
I wanted to. Nick said something great, which I thought which was ultimately you need to have something that has a yield. In this case, treasuries, or you needs to be sort of like a real business case, generate real revenues behind the scenes. I know this sounds very, very non-Web3 to say, but at least in the domain world, everybody's paying for a domain name renewal every year, whether it's $20 or $100, or in the case of my .ai name, something like $250, right? Now there's a natural yield over there, right? And people understand it. There is no regulation per se around my asset class, right? It is made up of 200 governments around the world. It is the OG decentralized org ever since the 90s, right? Bringing that type of attribute, I think, to this market makes a lot of sense. I would say the other thing too is monetizing the other thing too, which is what Rachel mentioned earlier, consumer. I mean, community is a monetizable asset. We have an investor, his name is Arthur Hayes. He loves half the memes that I see on this screen, right? Monetizing and arbitraging that absolutely is a hot opportunity in my opinion. Is that regulated? It's not for me to comment, right?
So what do you think we as an industry can do better to consumerize these complex financial products, right? How do we make it not only more accessible, but also more approachable? Does it just start with education, or is there something else that we can work on?
I mean, I don't think, I guess depends on what you mean consumerized. I don't think the average person should be dealing with complex financial products. I think the average person wants to earn their money, put it somewhere where they understand the risk that they're taking, just in in some sort of metric, and then they want to spend it and live their life. Most normal people, and there's not a lot of those in this room, don't want to sit there, wiring together complex derivatives, with the various financial Legos. Normal people don't want to do that. And so with Ether.fi, our approach is to abstract all that nonsense away. No concerns about chains, bridging, seed phrases. Just on-ramp once and then live your life. That's I think if crypto is to gain wider adoption, and at the scale of more than a couple 100,000 DeFi users, which is probably where the real metric is at these days. The products need to look like a Revolut or similar kind of neobanking products where it's just ridiculously simple and just focuses on actually providing you utility in your day-to-day life.
I think that's right. I was on a panel earlier and someone asked, how much do people care about yield? Well, there's hundreds of billions of dollars sitting in checking accounts that prove a lot of people don't hyper-focus on yield, right? And so I think it's making the experience as seamless as possible and honestly abstracting away in many parts the crypto-ness of it, right? And making it simple for a 50-year-old or a 60-year-old to just use and feel like they're using B of A or something hopefully a little bit better than B of A. But
yeah, just to make one, like the electric car didn't become a thing, with the Prius, right? Where it was like this guilt trip, like here's a shitty car, but you're going to drive it because it's good for Mother Nature. It became a thing when it was the best product, when it was just objectively a really great product, and the ideological part of it kind of got abstracted out. I think that's what we need to get to with crypto, when the crypto product is just the best product. The crypto-ness of it is just kind of a secondary thing, right? In the same way that when you order an Uber or a Grab or whatever, you're not sitting there thinking, oh, I'm using the internet to get a cab. You're just using a product. Like all the technology stuff gets abstracted away. I think that's, we'll know crypto is winning when people stop talking about crypto.
Okay, one last question. Where do you guys think we are today on the DeFi adoption cycle from, being from crypto native only, degens, to that mass adoption, the billion users everyone likes to talk about? Like, where are we actually, and how do we get to that endpoint?
I think we're still relatively early.
I feel like it's been early for 6 years for me. I've been in crypto 6 years,
Yeah,
and
yeah.
we've been saying it's early for 6 years.
Yeah, but I think if you look at the numbers, right, the number of users as well as TVL hasn't really grown all that much. So it's been stagnant. And I think early is less, I mean, it can be relative, right? But yeah, we still have, I mean, conversations around adoption. I think that's a pretty good sign that a lot of people are not familiar with like how DeFi operates, and definitely a lot more to do there.
My view, 1%. 1%. What?
I was going to say that.
1 million
1%.
daily active users in crypto. I mean, there's 5 billion users in the world, right? I'm sorry, less than 1%.
Yeah, I mean, all our metrics when you abstract out the 200 different wallets that each person has, is there's a few 100,000 actual DeFi users, of which maybe 5,000 have basically all the assets.
Yeah, I mean, Mike was just hammering, right? You have to have a better product. Something that I've been thinking about a lot this week is I feel like we're in the 6th inning of like speculative crypto and the 1st inning of like real crypto. Like it's taken a very long time to get the infrastructure on par to what like a traditional Web 2 experience is, where latency is sub a second. You're not sitting around waiting for a transaction to confirm for 45 seconds only for that to fail. And so I think we actually have the base level infrastructure in a place where we can start to see broader consumer adoption, because you have those Lego blocks ready for the product to start to compete. And I think now it's focusing on the user experience, also bringing in traditional products onto crypto that people want, right? Whether it's like, I don't think everyone wants to just trade governance tokens all day. I think they want to be able to access, whether it's traditional fixed income products or be able to buy gold, those sorts of assets on chain. We're starting to get there. The way I like to think about this whole space is very similar to like how cloud software and infrastructure evolved. Really started to get going in the early 2000s. Then you had AWS in 06, Azure, GCP in 08 and 10, and then 150 B2B SaaS companies went public, right? We're still 25 years into that now, and it's still compounding at a double-digit rate. I think we're in the early 2000s for real crypto. I think it's just going to start to get going, and in 20 years from now, I think you're going to see a world where all the financial services and payments are built on blockchain-based rails, because it is 10x, 100x better, right? What we're doing on the stablecoin side, some of it's DeFi, but some of it's just traditional, like real-world things. It's terrible to move money cross-border, and crypto and stablecoins are not just a 10x better experience. It is actually a 100x better experience, because you can say, okay, that's $100 million in the mempool. It'll be there in 10 seconds versus I sent a $10 million wire. I don't know when it's going to hit my other bank account. So I think it's early days, and it's going to take longer than people would like to think, but it's going to be a massive market. And at the end of this, I think you're going to see generational companies.
Early days. All right, well, thanks so much for being here. We have a lineup of 3 other panels, so I hope you guys stick around. And a big thanks to our panelists here.